Let me ask you something. What if the company that told you to buy Bitcoin was quietly selling it the entire time? Not a rumor, not a theory. This actually happened. And the numbers are sitting right there in public filings for anyone willing to look. I remember when BlackRock launched their Bitcoin ETF. The headlines were everywhere. CNBC, Bloomberg, financial Twitter was losing its mind. Everyone was saying the same thing. The institutions are finally here. Bitcoin is going mainstream. This is it. This is the moment we've been waiting for. And I'll be honest with you. I felt it too. That excitement. That feeling that something had permanently shifted. That the biggest money managers on the planet had finally looked at Bitcoin and said, yeah, we believe in this. So regular people did what regular people do. They followed the smart money. They bought in. They trusted the process. They trusted the institution. And then something very quiet happened. BlackRock started selling. Not loudly, not with a press conference, not with a single headline that said, hey, we're getting out. They just started moving billions out of their own Bitcoin ETF, the same product they spent months convincing the world to trust. And almost nobody noticed until the damage was already done. Here's what the actual data shows. From May 18th through the first days of June 2026, BlackRock's IBIT product saw over $2.4 billion worth of Bitcoin exit the fund. Bitcoin ETFs as a whole went on a 10-day red streak. Over $3 billion left the space in that single window of time. And Bitcoin, it dropped below $70,000. $766 million in liquidations wiped out in one day. Regular investors, people who bought because BlackRock told them to, watched their portfolios bleed, while the institution that created that confidence had already quietly walked out the back door. Now, here's where I want you to really think about this. BlackRock manages over $10 trillion in assets. $10 trillion! They're not making accidental moves. Every position they enter, every position they exit, it goes through layers of analysis, risk management, and strategic planning that most of us will never fully see. So when BlackRock publicly promotes a Bitcoin ETF, gets SEC approval, markets it to mainstream financial advisors and retirement accounts, drives massive retail inflow, and then starts pulling billions out while the public is still buying in, that is not a coincidence. That is a strategy. And I think most people deep down already understand how this works. They just don't want to say it out loud because it sounds too cynical. But let me say it clearly. Wall Street has always made money by being on the other side of your trade. Think about it. When you buy, someone is selling to you. When you panic sell, someone is buying from you. The entire machine runs on the fact that retail investors are emotional, reactive, and trusting, and institutional investors are none of those things. BlackRock did not get to $10 trillion in assets by being sentimental about Bitcoin. They got there by understanding exactly when to enter a narrative, how to amplify it, how to let the public pour money in, and then how to exit quietly before the sentiment turns. The ETF launch was the entry. The media campaign was the amplifier. Your buying was the liquidity. And the quiet sell-off was the exit. This is not illegal. That's the part that really stings. Everything BlackRock did exists somewhere in a filing, in a report, in a disclosure that technically satisfies regulatory requirements. They are not breaking rules. They are playing a game that the rules were written to allow. But here's the mistake I see people making over and over again. And I've made this mistake myself. We treat institutional moves as signals to follow, instead of signals to study. We treat institutional moves as signals to follow, instead of signals to study. When a massive institution enters a market, the instinct is to jump in with them. But what most people miss is that institutions enter early, when prices are low and risk is manageable. By the time the ETF launches, by the time the news is everywhere, by the time your financial advisor is recommending it, the institution has already been positioned for months, sometimes years. You are not getting in with them. You are getting in after them. And when they decide the trade is done, when they've captured the return they came for, they leave quietly through mechanisms most retail investors don't even know exist. The 10-day outflow streak from Bitcoin ETFs didn't happen because the market randomly turned. It happened because large, coordinated positions were being unwound. And the people on the other side of those exits were everyday investors still holding, still believing, still watching financial news that was 3 weeks behind what was actually happening in the order books. So, what do you actually do with this information? First, stop treating institutional interest as validation. An institution buying Bitcoin does not mean Bitcoin is going to the moon. It means the institution sees an opportunity to profit. Their exit timeline is not your exit timeline. Their risk tolerance is not your risk tolerance. Second, watch the flows, not the headlines. ETF inflow and outflow data is public. Sites like Farsight Investors publish Bitcoin ETF flow data daily. When you start seeing consistent outflows from major ETF products, that is a signal worth paying attention to, regardless of what the talking heads are saying on television. Third, understand that the narrative and the reality are almost always running on different timelines. The narrative is built in advance to create the conditions for a trade. By the time you hear the narrative loudly, the trade is usually already well underway. And fourth, this is the one most people skip. Build your own thesis. Not based on what BlackRock is doing, not based on what some influencer is saying, based on your own understanding of the asset, your own time horizon, and your own financial situation. Because the only strategy that actually protects you is one that doesn't depend on trusting someone whose incentives are fundamentally different from yours. I'm not here to tell you Bitcoin is bad or that ETFs are a scam. That is not the point of this. The point is that the financial system has always had a layer that most people never see. A layer where the story being told publicly and the moves being made privately are two completely different things. And the gap between those two things, that gap is where the money moves. BlackRock is not your financial advisor. They are not your friend. They are not rooting for your portfolio to grow. They are a business, an extraordinarily sophisticated, extraordinarily well-resourced business. And their job is to generate returns for their clients and their shareholders. Sometimes that aligns with your interests, and sometimes it doesn't. Knowing the difference is the only edge that actually matters.